Gold just closed above $4,180. Silver's sitting at $62.86. The gold-silver ratio has compressed to 66.5. And that September rate hike probability, the one sitting at 67% just 6 days ago, has now dropped below 50%. You've been waiting for this moment since January 30th. That was the day Kevin Warsh got nominated, and gold crashed 9% in a single session. That was the day every precious metals investor who'd spent 2025 building a position watched an all-time high of $5,594 get wiped out inside a single trading day. That was the day the paper market decided, without asking you, without consulting the supply deficit, without checking central bank purchase data or fiscal projections or oil prices, that a hawkish Fed chair meant gold was done. 5 months later, gold's down 28% from its January peak. Silver's down 52% from its January high of $121.62. 7 straight down weeks. And through all of it, everything this channel has been building, the oil story, the Iran ceasefire, the PCE data, the dot plot mechanics, the ETF overhang, the 5 task forces, the war pragmatist thesis, every piece of it has been pointing toward one moment. The moment when these suppressive forces finally reverse. When the direction of the data lines up with the direction of the structural case. When a market that's been pricing the worst-case scenario has to reprice against what's actually happening. That moment is now. The signal came from Sintra. The signal arrived this week, and it didn't come from where most people were watching. It came from Sintra. On July 1st, 2026, Kevin Warsh stood at the European Central Bank's annual forum in Sintra, Portugal, his first major international appearance as Fed chair, sharing a panel with Christine Lagarde of the ECB, Andrew Bailey of the Bank of England, and Tiff Macklem of the Bank of Canada. The room held some of the most powerful monetary policymakers on the planet, and Warsh, who hadn't given a major public address since his June 17th press conference, said something that sent over $1.25 trillion flooding back into precious metals within 6 hours. He said inflation risks have come down in recent weeks. That's the signal, not a pivot, not a rate cut promise, not a reversal of the hawkish stance he set on June 17th. Just 9 words, describing a direction rather than a destination. Inflation risks have come down in recent weeks. The same man who said prices are too high in that same appearance, who reaffirmed the 2% target, who told the room the Fed will deliver price stability, that same man also said the risk of persistent inflation is fading. In a market that's been priced for maximum hawkishness since June 17th, direction matters more than destination. Any credible, on-the-record acknowledgement from the chair himself that direction has shifted is a repricing event. And this was the biggest single-session repricing event in precious metals since the correction started. What Warsh actually said, let's walk through the full context because the mainstream coverage ran with the hawkish headline and buried the bullish signal underneath it. There were really 3 parts to what he said, and you need all 3 to understand what just happened. Part 1. The hawkish anchor. Warsh's own words at the ECB forum. We're all in the price stability business. That might not be our only business. But if there was a common thing I heard over the last couple of days, it was open-mindedness on these questions of AI, open-mindedness on productivity. But we've all looked around and we've seen that prices are too high. Prices are too high. That's the line every outlet ran with. And it's true. Core PCE is sitting at 3.4%, twice the Fed's 2% target. The committee isn't declaring victory here. Warsh isn't walking back the price stability commitment. Part 1 stands. Part 2, the signal. Bloomberg, the Financial Times, CNBC, and PBS all confirmed the same line. There are signs that the threat of persistent inflation has moderated. Separately, Warsh specifically pointed to inflation expectations, the kind measured through surveys and bond prices, as having come down. The 5-year Treasury inflation break-even rate, which had spiked during the Iran war oil shock, has fallen to 2.26% as of July 1st. The 1-year break-even has dropped nearly half a point since May. These are the market-based real-time inflation gauges Warsh said at Sintra he actually prefers over official government statistics, and they're already tracking a path noticeably softer than what the June dot plot was built on. Part 3. The global validation. This is the part that's gotten almost zero coverage in the precious metals world, and it's arguably the most important piece. Warsh wasn't alone in saying forward guidance had been a mistake. Christine Lagarde, on that same panel, in front of that same room, said she had one regret: feeling bound by forward guidance. Andrew Bailey said he opposes the practice too. Tiff Macklem agreed. All 4 of the most important central banks in the developed world, the Fed, the ECB, the Bank of England, and the Bank of Canada, stood together at Sintra and said forward guidance as a policy tool was a mistake. "We have found common cause," Warsh said. "That matters enormously if you're holding precious metals, because 14 years of gold and silver suppression through the pre-FOMC short cycle was never just an American problem. It was global. The dot plot was a Fed invention, sure, but forward guidance, the broader practice of projecting future rate paths, was running simultaneously at the ECB, the BOE, and the BOC. Those mechanisms created the same pre-announcement short cycles in gold and silver that the Fed's dot plot did. And in one afternoon in Portugal, all 4 chairs just told the world those mechanisms were wrong and they're stepping away from them. Then the data backed it up. Speeches are just talk. Data is reality. The morning after Warsh's Sintra appearance, the Bureau of Labor Statistics dropped the June non-farm payrolls report. The U.S. economy added just 57,000 jobs against a consensus of 115,000, less than half, the weakest print in 4 months. April and May got revised down by a combined 74,000, which means that 172,000 May number that pushed rate hike odds to 67% and crashed silver 6% in a single session 3 weeks ago has now been revised down to 129,000. The blowout that justified the hawkish narrative wasn't as strong as it looked. The CME FedWatch tool reacted instantly. September hike odds fell from 67% to below 50% within minutes. Gold broke above $4,100. Silver climbed past $61, up more than 3%. The gold-silver ratio compressed to 66.5, tighter than it's been in weeks. 2 events, 2 sessions. Sintra and the NFP miss. Between them, the main force suppressing precious metals, the rate hike permission structure built on a 172,000 job blowout and a 4.2% energy-driven CPI print, lost the factual ground it stood on. Here's the part that should really get your attention. Here's what changes how you should read that drop from 67% to under 50%. The 67% itself was an overcorrection. The May number that pushed it there has been revised down to 129,000. The oil-driven inflation reading that gave hawkish committee members their cover was driven by a war that's ending. Warsh's own preferred inflation gauges, the market-based break-evens, the trimmed mean, were already decelerating faster than the lagging official numbers showed. That 67% was the market pricing the worst-case version of data that was already going stale. The drop below 50% is the market starting to catch up to what Warsh has apparently been looking at the whole time. And the calendar ahead confirms that repricing should keep going. June CPI drops July 10th, 7 days from now. Brent crude is under $70 against a comparison base of roughly $68 to $70 from June of last year, which produces year-over-year energy inflation near zero. May's reading showed energy up 23.5% year-over-year. June should show energy near flat. Headline CPI, which was 4.2% in May with energy as the main driver, should decelerate hard in June, not modestly, hard. The math isn't uncertain here. With oil falling from the $126 range down to $70, a June CPI print at 3.5% or lower is arithmetically plausible. And if that happens, September hike odds don't sit at 50%. They keep falling toward 40%, then 35%. At 35% odds of a hike, gold and silver aren't trading against a worst-case scenario anymore. They're trading against a likely hold. And a likely hold in a market where every major institutional price target sits 20 to 50% above where we are now is a completely different environment than what's been in place since June 17th. 3 dates to mark on your calendar: July 10th, June CPI. Watch the energy component specifically. If energy year over year comes in below 5%, against May's 23.5%, that's your confirmation the hawkish permission structure is gone. Watch the 2-year Treasury yield, watch the dollar index, watch what gold does in the first 30 minutes after the print. If gold pushes above $4,214, the level FX Empire flagged as the breakout trigger from the prior base building pattern, that's technical confirmation the structural repricing is underway. Hold above it on a closing basis and the conversation shifts. The $4,340 to $4,730 no man's land that J.P. Morgan's analysts described stops being a resistance ceiling and starts looking like the next destination. And silver, which typically moves at roughly 3 times gold's percentage swing in comparable conditions, opens up a visible path from $62 toward $80 for the first time since this correction started. July 28th, Warsh's second FOMC meeting. No dot plot, no summary of projections, just a statement and a press conference. He'll be looking at June CPI, June NFP, and June retail sales when he steps up. If all 3 confirm the energy-driven inflation is fading and the labor market is cooling, expect softer language than June 17th's stripped-down, no-easing tone. That would hint that September's dot plot could show fewer officials projecting hikes than June's 9. August 12th, July CPI, the second straight post-ceasefire inflation reading. By then, 2 full months of sub-$70 oil will be baked into the data. If July CPI comes in under 3%, which the oil math makes plausible, the hawkish case isn't just weakened, it's structurally broken. A committee that projected hikes off a 4.2% energy-driven CPI can't justify following through into a 2.8 to 2.9% CPI produced by a war that's already over. The data pulls the rug out, and Warsh, who's said repeatedly that he follows the data, follows it. What this means for silver specifically, the 7 straight losing sessions that dragged silver from $66 down toward $58 are reversing, and it's reversing faster than gold for the same reason it fell harder in the first place. Think of silver as running on 2 engines. The monetary engine, the rate-sensitive, real yield-driven side that ties silver to Fed expectations, had been running full speed in reverse since June 17th. Hike odds at 67%, the dollar at a 14-month high, real yields elevated. Every session, that engine dragged the price down. Then, on July 1st, Warsh's Sintra comments took that engine out of reverse and into neutral. On July 3rd, the jobs miss pushed it into first gear, forward. Hike odds under 50%, the dollar softening, real yields starting to compress. The industrial engine, the one behind 60% of silver's annual demand through solar, EVs, AI data centers, and semiconductors, never reversed. It never even slowed down. The Silver Institute confirmed this week that the global silver market is heading into its 6th straight annual supply deficit, 46.3 million ounces, wider than last year's 40.3 million. That deficit keeps compounding no matter what gets said at a Portuguese forum. Solar farms going up today will draw on silver paste for the next 25 to 30 years. AI server farms under construction right now need silver in every board, every connector, every power system. None of that pauses because the gold-silver ratio is at 66 or because the paper market is still pricing in a hawkish Fed. Both engines are now pointing the same direction. The monetary engine just flipped on Warsh plus the jobs miss. The industrial engine never stopped. That's a spring loading up against a structural floor, the multi-year supply deficit. That doesn't care about quarterly projection charts. The part almost nobody's talking about. Here's the piece of the Sintra story that hasn't gotten real coverage anywhere in the precious metals space, and it might be the most important development for the long-term thesis since Warsh was nominated. Warsh told the room in Sintra, "My hope, my aspiration, is that 9 to 12 months from now, we're going to be using new technologies to understand what's happening in the real economy in a contemporaneous, real-time way that positions us as central bankers to make better decisions." Then he added something no sitting Fed chair has really said out loud before. We're no longer going to have to rely solely on data that we get from government agencies with mismeasurement problems that have surveys that are no longer relevant. Mismeasurement problems. Surveys that are no longer relevant. The Fed chair on the record at the ECB's biggest annual forum, publicly suggesting that the official economic data his predecessors relied on for years of policy decisions might have been flawed. Not just late, not just imprecise, but potentially mismeasured, and that he's actively building alternative data infrastructure to replace it. That has a real, specific implication for anyone holding gold or silver. If official inflation and employment data has had systematic errors baked in, which Warsh is now suggesting on the record, then every rate decision built on that data over the past few years carries compounding uncertainty. Every hike, every cut, every hold based on CPI and payrolls numbers rested on figures the incoming Fed chair himself now questions. And every gold and silver price suppressed by the market's read of that data was suppressed against a benchmark that might have been wrong all along. This isn't speculation. It's the Fed chair telling the world's central bankers, on record, that his own institution is walking away from its historical data infrastructure because of measurement problems. And buried in that admission, whether he said it outright or not, is the possibility that the real economy, properly measured, may have been running hotter, with more fiscal strain and more structural support for precious metals than the official numbers ever showed. Going back to first principles. Here's the deepest layer of what Warsh said at Sintra, deeper than the 9 words on inflation, deeper than the AI productivity comments, even deeper than 4 central banks repudiating forward guidance together. It's what he revealed about the Fed's own thinking. He told the room, "There is a willingness by my colleagues in the central banking community around the world to go back to first principles. We all want to make the best decisions we can." Every major central bank, after 14 years of forward guidance, dot plots, quantitative easing, and a communication playbook, the ECB's own president just said she regretted, all of them, at once, going back to first principles. Institutions don't go back to first principles unless the principles they'd been running on failed. And the principles that failed here were specific. That forward guidance produces better outcomes than data-dependent silence, that projecting rate paths reduces uncertainty instead of manufacturing false certainty, that oversized balance sheets are neutral to market pricing rather than distorting it. All 3 are now being rejected simultaneously in public by every major central bank, and every one of those rejections is a structural argument for the one asset class that never needed forward guidance, never needed a dot plot, never needed a projected rate path to hold its value: physical gold and silver. Goldman Sachs put it plainly in a note this week. Samantha Dart, co-head of Global Commodities Research, argued that gold's sharp 4-month decline doesn't mean the bull case is closed. Goldman's focus is on sovereign demand, the structural floor built on central bank accumulation that never paused, not for Warsh's nomination, not for the Iran war, not for the hawkish FOMC, not for 17 straight weeks of negative sentiment in the paper market. That floor has been there the whole time. The paper market is only now starting to catch up to what sovereign buyers have already known for 19 months. Earlier this year, the World Bank projected precious metals would surge 42% in 2026, the top-performing commodity class of the year. From the correction low near gold's intraday touch of $3,942 in late June, a 42% move puts gold above $5,500. Maybe not by year-end, but the structural trajectory the World Bank was pointing at hasn't changed, the supply deficits haven't changed, the central bank buying hasn't changed, the fiscal backdrop hasn't changed, the only thing that moved was the near-term rate expectation, and that just shifted. What to watch over the next 30 days? Mark July 10th. When June CPI drops at 8:30 a.m. Eastern, watch the energy component first. If energy year-over-year comes in below 5% versus May's 23.5%, that's the number telling you the hawkish permission structure is gone. Watch the 2-year yield move in real time. Watch the dollar index. Watch what gold does in the first half hour. A break above $4,214 that holds on a closing basis is the technical confirmation this repricing is for real, and it opens the door to the $4,340 to $4,730 zone becoming a destination instead of a ceiling, with silver's higher beta move giving it a visible path from $62 toward $80. This is what you've been waiting for. Not certainty. There's no certainty in any market, in any asset, ever. But the confirmation that the direction of the suppressive forces has changed just arrived from a source the market has to take seriously. The Fed chair himself at the most important central banking forum on Earth, flanked by 3 other central bank governors who said the same thing in the same room, that inflation risks have come down. Add 57,000 jobs in June, oil under $70, June CPI 9 days out, September odds under 50%, and every major bank's target, Goldman's $4,000, JP Morgan's $5,000 to $6,300, Morgan Stanley's $5,200, Deutsche Bank's $4,000, sitting right where it was before the correction began. None of those banks walked back their thesis. They pushed out the timeline because the oil war delayed the path. That path is clearing now. The war is ending. The inflation it caused is unwinding. And the man at the head of the Fed, who spent 15 years arguing markets should price the real economy instead of the Fed's projections of it, just told you, in 9 words at Sintra, that inflation risks have come down in recent weeks. The signal has arrived. June CPI is 9 days away. You already understand the thesis. You've understood it for months. The real question is whether you're positioned to capture the repricing when the data confirms what the signal already told you. So here's what I actually want to know. When you heard Warsh say at Sintra that inflation risks have come down, when you watched gold add over $90 in 2 sessions and silver rally 3.75% on that news, did you already own your position, or were you watching from the sidelines? Drop it in the comments. That thread is going to be the record of where this community stood on July 3rd, 2026, the day the signal arrived. 7 days to June CPI. The clock's running, and for the first time in 5 months, it's running in your favor.